All right, let's dive right in. Today, we're cracking open the professional analyst playbook to build what we're calling the ultimate investor's checklist. You know that feeling, right? You're staring at a stock chart and you're wondering, is this the next big thing or am I just taking a massive gamble? That feeling of uncertainty is exactly what we're going to tackle today.
Because here's the secret from the pros. Real analysis isn't about some lucky break or a random gut feeling. It's methodical. It's disciplined. It's about having a system, a toolkit you can use on any company you're looking at. So that's our promise for this explainer. We're cutting through the noise and the jargon to give you the exact step-by-step blueprint that the pros use. Let's get to it. Okay, first things first. The very first tool in any analyst kit is all about understanding the big picture. You have to size up the industry and see exactly where a company fits. I mean, you can't really judge a fish without knowing the size of the pond it's swimming in, right? So, an analyst's first move, it's to break down the business. Just like this, we're asking, how does this company actually make its money? We dig into each segment to see how profitable it is, how fast it's growing, and how dominant it is in its own market. This kind of breakdown tells you almost instantly which parts of the business are the real engines, and which ones might just be dead weight.
All right, so once you get how the business actually works, it's time for a checkup. We need to check its vitals. This is where we put the company on the examination table and use our next tool, the financial health scanner. It's a quick but incredibly powerful diagnostic.
And really, the question we're answering here is super simple. Is this company financially solid? Can it pay its bills, handle its debt, and still have cash left over to grow? Or is it secretly living on borrowed time?
And here it is, the 10 vital signs on that scanner. I know it's a lot to take in, so feel free to pause. But just look at the pattern here. We're checking for growth from top to bottom. We're checking for safety, making sure its assets cover its debts. And we're checking for shareholder value. Is it actually making each share you own more valuable? This isn't just a random list. It's a systematic, head-to-toe physical for the company. Let's just zoom in on one of those vital signs, gross margin. Why do pros get so excited about seeing a number consistently above 40%? Well, think about it. It's a huge sign of a powerful business. It usually means the company has some serious pricing power and it runs a really efficient operation. Those are two things that lead to strong, healthy profits. Okay, here's another big one, debt. Remember that point on our checklist? The rule of thumb is pretty straightforward. Can the company pay off all its long-term debt with less than 4 years of its profits? If the answer is yes, that's a huge green flag. If not, well, you could be looking at a company that's being weighed down by a mountain of IOUs. Now this might just be one of the most important checks of them all. Is the main business, the day-to-day operations, generating enough cold, hard cash to pay for its own future, to fund its own growth? Or is it constantly having to take out loans or sell off little pieces of itself just to get by? A yes to that first question, that's the sign of a truly self-sufficient machine. So, our health check is done. The company is solid. But now comes the million-dollar question, or maybe the billion-dollar question. What's the right price? Because even a fantastic company can be a terrible investment if you pay too much for it.
This is fundamental. You've got two main ways to think about price. First is absolute valuation. That's where you try to figure out what a company is worth all on its own, based on its own fundamentals. The other way is relative valuation, which is basically just comparison shopping. You're looking at its price tag next to all the other similar companies on the shelf.
And this is what that comparison shopping looks like in the real world. You literally line up your company right next to its biggest competitors. You look at metrics like the PE ratio to see if it's a better deal. You can even use things like the PEG ratio, which cleverly factors in how fast the company is growing. This gives you that critical context to figure out if you're looking at a real bargain or something that's just, cheap for a reason.
All right, you've done the work. You've sized up the field, you've run the health check, and you've assessed the price. Now, it's decision time. Time to put it all together.
This final step is all about being brutally honest with yourself. I mean, actually write it down. On one side, your investment thesis. What are the clear, simple, powerful reasons to buy this thing? And on the other side, what are the biggest risks? What could go wrong? Putting it down like this, side by side, stops you from just falling in love with a good story and forces you to make a balanced call.
And then, right before you make a move, you ask yourself this one last, powerful question. It changes everything. It stops you from thinking like someone who just rents a stock and makes you think like someone who would own the business. Would you actually buy the whole company? For the long haul, does its story make that much sense to you? That is the ultimate gut check.
So there you have it. A system, a process, a way to understand the business, check its health, find the right price, and make a disciplined final call. The toolkit is yours now. The only question left is, which company are you going to analyze first?